Hello and welcome to the Movie Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, let's jump into kind of notable market volatility in August and kind of recap the month and a look ahead.
Yeah, Jerry, kind of like you said, August started out as a very volatile month. A lot of concerns on the labor market to start the month, but then you had a very rapid recovery and ultimately finishing the month higher. So if you look at the S&P 500, that was up about 2.25% for the month. If you look at small caps, those continued to struggle and actually ended the month negative. And we continue to be on the same trajectory of the last few months where value continues to outperform growth, and you're starting to see more of an impact and more of a focus on valuation. And if you look at corporate bonds and interest rates slightly coming down, it was another strong month for bonds. And interestingly enough, international stocks also started showing some signs of life and have had a relatively decent couple months after a weak start to the year. The one other area that we're keeping an eye on is the concentration risk within ETFs, and that continues to be an important factor and something for us to continue to watch and be mindful of. So with that kind of 30-second recap of a very volatile month, I think as we pointed out, let's talk a little bit about what the Fed is doing and what the outlook is for the rest of this year.
Well, David, all eyes are on the Fed from here for the next few months. And with the full expectation of the Fed starting to cut interest rates next week, the question is, what is the Fed concerned about? What are they looking at? So if you kind of take them in order, the first being inflation, the inflation trend and trajectory continues to be very favorable. So the Fed overall is much less concerned about inflation, than it had been earlier this year and prior year overall. So when you look at both, CPI comes out tomorrow, you're expecting another 0.2. So you'll see, headline be a little bit still in the threes, ex food and energy. The total headline number will be in the twos. So, but again, when you look at gasoline as another example, gasoline futures have dropped off dramatically, since July. So looking ahead, the impact to prices people are going to continue to pay at the pump is going to be lower in the weeks and months ahead based on demand. And other factors include OPEC, which wants to increase supply. They put that on pause just given where oil prices are near term, but you'd expect that increase of supply coming in future months as well, which should continue to put a ceiling into oil prices and gasoline ultimately. So when you look at inflation, the Fed is not concerned at all about inflation, and it's not likely to bubble up. The Fed is really focused now on the labor market and the overall economic growth. And again, when you look at the labor market, it continues to level out and weaken overall. So it's not booming like it was a couple of years ago. It's not negative. It's just, overall flatlining for the most part. And again, when you look at the JOLTS job survey, when inflation peaked in 2022, there were over 12 million job openings. We've filled those overall in the economy so that the labor market is much more in balance. And again, when you look at the last 2 months of headline job data, it's been around 100,000, right? Headline number a little bit higher, but you continue to have revisions lower each period. So again, the Fed's more concerned right now about the labor market holding up than they are inflation. And then you turn to the economy, right? The economy continues to be decent, right? We had 3% second quarter GDP. And when you look with a couple of weeks to go here in the third quarter, you're solidly in the mid twos. So it's unlikely to see GDP for the third quarter going much below 2. But again, these are the things for the Fed to monitor. And then when you look to next week on what will they do, right? The challenge with the Fed is, will they cut 25 basis points or 50 basis points, right? Based on where inflation is trending and the labor market, you can make a very strong argument they should do 50 basis points. But now, to me, I think you run into this challenge with the Fed on signaling, right? Do they want to do 50 basis points and have concern about the economy, or do they want to stay at 25 basis points and say we're on kind of this trajectory to lower rates steadily over time, as opposed to doing 50? There might be some sense of panic on the Fed's part about the economy of the labor market. So that's really the challenge the Fed faces. Inflation, rearview mirror, It's really the labor market and the economy, and then the challenge. So for me personally, I think the Fed will do 25 basis points. I think they're more concerned about, signaling that they're more concerned than the market, and concerned that the market would react negatively.
Yeah, Jared, if you look at, I think the general trajectory, the expectations of the Federal Reserve and of the market, you see that the market has more expectations for rate cuts than the Federal Reserve does, but you do see that the trend is in the right direction. And so ultimately, over time, the question is, I think, kind of like you said, how quickly do rates come down, and what's the ultimate path, and where do we land? But at the same time, the direction is lower interest rate environment, which should help a lot of smaller companies, should help a lot of the segments of the economy that are heavily reliant on interest rates, and should provide an overall tailwind to overall economic growth. So a couple areas that we'd be looking at would be assets moving more towards risk, right? Because if you're no longer getting that 5% interest rate on your cash, you're going to likely seek out dividend stocks, and you're going to likely be looking to extend some of the duration on your bond portfolio.
And David, if you stop there for a second on, I tend to think that you could see a trend in money markets a little bit like, let's say, oil prices. Oil prices go up immediately at the pump, prices are higher. Oil prices go lower, it tends to take a few days or a few weeks for that to trickle through. So when you think about, like you said, 5% is just a headline number on money markets that everybody gets a sense that I need to get that higher yield. So now as the Fed cuts interest rates, it wouldn't be a big surprise if all of a sudden that 5 turns into a 3, even though the Fed might only cut 25 basis points, anticipating those future cuts. So to your point, as money market yields go much lower, it's going to create a need to move that money into other avenues, and it create a lot of activity in year end and into next year.
Yeah. So again, I think one of the areas that'll benefit is risk assets in general, just because if you're not getting that rate of return, you're going to look for other areas to meet your income needs. Dividend stocks would be in that category, bonds as well. And then one other area of the market that we've been talking about quite a bit and has really struggled, but should hopefully be improving shortly, would be the housing market. We've seen basically no activity, and as rates have come down a little bit, there's been a huge spike in refinances. But seeing more purchases, more refinancing activity, and ultimately putting more dollars into the consumer pocket that they can then use to spend in other areas of the economy versus paying for their mortgage.
And when you look at mortgage rates, David, obviously a couple of years ago, they were in the 2 to 3% range, and everybody would like to have that nice low mortgage rate back. And that's a thing of the past for the most part. Overall, though, things have improved, and you see a path toward the low 6s or maybe upper 5s as the Fed adjusts interest rate policy over the next few months. And to your point, there haven't been a lot of conversations because of the 7.5% mortgage. But as you see that headline of the Fed cutting, a lot of individual people will really start to look to buy the house they've been waiting, especially if they're anticipating much lower rates ahead. And when you think about the impact to the overall economy, it could be substantial, looking into the year end and next year, because to your point, it's more or less been a housing depression as far as activity, over the last couple of years, because there have been far fewer transactions in the used home market, right? Existing home sales continue to be, very low. But as mortgage rates move lower, it bridges that gap between the person that has the 3% mortgage and wants to trade up. Upper 5s, low 6s make that much more attainable. And again, that could have large implications for the overall breadth of the economy as you think about buying a new home, furniture and paint and everything that goes into driving things overall. So it's a trend to watch for. The other thing I think is interesting too on cautious optimism going into next year is incomes overall. So especially as inflation trends back toward 2%, Goldman Sachs had a report out many months ago, kind of linking the positive with wage inflation still being at low 4s. If inflation is in the 2s, consumers are poised to maintain spending, savings, and kind of have a steady economy looking into year end and into next year. Again, assuming the labor market continues to hold and look at least at the level we've seen currently.
Yeah, so those areas, one of the other things we'll continue to watch for will be valuations. Slower growth will make valuations a lot more impactful. And just seeing how value stocks perform relative to growth should be an area of a lot of opportunity. Because again, if you lower that growth rate from 20% to 10% for some of these tech companies, it can have a significant impact.
Well, on top of that, David, my opinion is we're kind of entering what I'm calling a boring market looking ahead. And what does boring market mean to us? A little bit slower growth rate, as you said. Interest rates are coming down to adjust for the slower inflation. Hopefully, not a major slowdown in the economy. But if you can hold that GDP around 2%, even if the labor market holds in this 50 to 150,000 range of job growth, you should see some adjustment. Because if you think just big picture, it's not a big deal to go from 250,000 down to 150 or 100,000. We're still growing, but you think about the impact. The fewer hires you have, that's less software needed, that's less things you're buying for the fewer people being employed. So it just brings down that growth rate for companies that are impacted in those areas. You're still growing, just not at the same rate. So there continue to be an overall pricing and PE adjustment or valuation adjustment, with that slower growth. So it brings you back to where do you go? And that's where valuation, breadth of the market could impact. And again, looking in the next year, taxes are going to be a conversation. Tax cuts expire at the end of next year. So do you take capital gains, do you accelerate income? And again, that could have an impact on the higher valuation in this quote boring economy or boring market we think could persist for some time. So with that, we want to thank you for tuning in this month, and we'll touch base, after the Fed and see what happens into October and beyond.
Thanks.